Thank you all for joining us for the taxes workshop. Joining us today is Allison Archer, who owns her own firm right here in our town. She's going to provide us with a basic understanding of taxable income and help us know what to expect when tackling our very own tax returns. So I'm going to hand it over to her to get us started. Thank you.
Thank you guys for having me today. Again, my name is Allison Archer. I got my MBA from UNLV in 2005, and I got my undergrad from University of Arkansas in 1995. So I did take a little break. I've owned my own practice since 2004. And I will tell you, this will probably not be the most exciting presentation you've ever been to, but hopefully, I hope each of you can leave with something that you can use on your tax return or your parents' tax return or a friend. Just knowing that some of the laws are out there at least gives you something to research. So I want to present this, but I want to point something out is that nothing with the IRS is simple. Nothing. Everything we're going to talk about today, there is some type of caveat where you can claim something or you cannot claim something. So never assume that there are no special rules because everything is complex. So especially lately, there's a lot of new COVID exclusions and tax relief out there for people. So just knowing things are out there, at least you can move forward and research something that might pertain to you. And I am going to focus a little bit more on education, deductions, credits, just so you know things that are out there and may be available to you. So we'll get started. And like Navina said, just if you have anything, type in the chat. And Navina, just interrupt me if we want to do questions at some point. So, all right, so let's start. The first thing is who is required to file. So if you are a single person, so that means not married, and you earned income over $12,400, you are required to file. Married filers, that would be $24,800. And that's earned income. So that means a W-2, you're out there earning that income, you have a job. Unearned income is interest, dividends, things like that. So if you make over $1,100, you have to file as a single person. Self-employment income, if you make over $400. So self-employment income would be considered you do some contract work and you get issued a 1099 NEC, and we'll talk about that in a little bit. But if you received a 1099 over $400, then you have to file, and you will most likely owe self-employment tax on that money. And then you also have to file if you owe special taxes. So you took an IRA distribution and you took it before you were age 59 and a half, or you have a household employee and you have to pay household employment taxes. If you take an HSA distribution, or if you receive the premium tax credit, which that is if you get your health insurance at the marketplace, then you may be getting a subsidy. And so you have to file your return at the end of the year to true that up and see if your subsidy, if you get additional or if you have to repay a portion of it. And then you also need to file if you had additional taxes withheld and you think you maybe due a refund. So always, if you have taxes withheld in box 2, I would say at least go through the process to see if you might be able to get some of that money back. And then where do you file? So just so you know, anyone who makes under $72,000 can file for free on the IRS website. So it's www.irs.gov, and you just go to file my taxes. I would recommend everyone try this, but I will let you know if you have any special situations, they're going to say, oh, sorry, you can't file for free, but you can fill out the forms. I would never recommend filling out the forms on paper. It's just not worth it. There's software that can do these things for you. If you have a more complex situation, there's TurboTax. You can file for less than $100. We don't have state tax in Nevada. It's very user-friendly. I don't use TurboTax, but way back before I started doing taxes, I used TurboTax, and it's just very user-friendly. If you think you have a complex situation, then you should use a CPA or an enrolled agent. Now, there are other people who prepare taxes, but I'm going to tell you you should use a CPA, an enrolled agent, or attorney because they can represent you in front of the IRS if there's ever an issue. Hopefully that won't happen. And if you do have someone that you pay to do your taxes, make sure that they sign your tax return. There are people out there who will take your money and do your taxes, and then they won't sign your return. That's not good. You need to get them to sign. I will tell you, I went through an audit. A client of mine was having an audit and then came to me, and I started representing them. And the IRS agent told me it is easier to hang out a shingle and do taxes than it is to get a license to cut hair. So just so you know, anyone can say that they do taxes. You just need to really be careful and make sure you get someone who's going to sign your return and who will definitely be there for you if there's ever any audit issues. And then when do you file? Everybody knows this. Well, okay, 2020 was a weird year, so it was July. But right now, corporate returns, business returns are due March 15th. Personal individual returns are due April 15th. Now, you can always get an extension. You can get a 6-month extension to file, but just know that's an extension to file your return. It is not an extension to pay. Now, no one's going to come after you if you don't pay your taxes on April 15th, but I'm going to tell you that penalties and interest start to accrue. And let's just say you're like, well, I can't pay, so I'm just not going to file. File the extension, because if you happen to owe taxes and you don't file that extension, your penalty can be up to 25% of the tax that you owe. So always file an extension and try to pay as much or as reasonably correct amount as you can by April 15th. Now, today, the current deadline is April 15th. But there has been a lot of talk. The IRS isn't even accepting returns for 2020 yet, and they don't accept them until this Friday. So, CPA groups I'm in are all talking about, are they going to extend the deadline? What's going to happen? Right now, they're not. I do think it's possible, especially if there's another stimulus, and there's just a lot of things going on. It makes it really hard to meet that deadline, but people can file an extension. That gives individuals till October 15th. And some common forms that you'll get, if you work a job, you're going to get a W-2. And the main things it's going to show you is your wages and how much tax was withheld. It's also going to show you how much you paid into Social Security and how much you paid into Medicare. But that doesn't really impact your taxes unless it was done incorrectly, which is rare. A 1099 NEC, so that's non-employee compensation. That is maybe you do some side work and somebody pays you with a 1099, but you do the work on your own time. You're not really an employee where someone's telling you what to do. Then you would receive a 1099. 1099 interest and dividends, that's for unearned income. If you earned interest at a bank or maybe dividends from some stock you hold. And then a 1098, it shows the mortgage interest that you paid. If you happen to own a home, it's going to show you your mortgage interest. It's going to show you real estate taxes. It's going to show you if you paid any points. That's all going to be listed on that statement. And then for you guys, a 1098-T shows tuition paid. Most of my clients, they always tell me that they have a kid or a child in school, but they never send me the 1098-T, which tells me that you must have to go online to get it. So a lot of them have to wait for their student to go get that form, off the university website. Another one, 1099-Q, these are just distributions from 529 plans. So we'll talk a little bit about 529 plans, but basically that's just a distribution that you get tax-free that covers education expenses. And then the 1098-E is a student loan interest that was paid that you may get, and they usually mail those. So, and all these forms, let me see, all of these forms, most of them are due to be mailed by January 31st. This year it was February 1st. The interest and dividends may not be mailed until February 15th, or if you happen to sell stock, that's usually the middle of the month too. So just be aware of that. If you're trying to file your taxes right now, you may not have all your forms if you're expecting those. And okay, so this is the first credit we're going to talk about that is an education credit. It's an amazing credit, but there's one bad thing for you guys. It only applies to undergrad. But if you have a sibling maybe or somebody in undergrad, this is a great credit. So you get up to $2,500 credit per eligible student. And I want to explain the difference between a credit and a deduction. So let's say you do your taxes and your tax liability is $5,000. If you get a credit, it offsets that like dollar for dollar. So you owe $5,000 and you have a $1,000 credit, you now owe $4,000. So it's very beneficial. A deduction is you get to deduct that from your income before tax is calculated. So it's still helpful, but really you're only saving whatever your tax rate is. So we'll talk about that in a minute, but the American Opportunity Tax Credit, it's up to $2,500 per student, and 40% of that could be refundable. And that just means, let's say you paid in no tax. You could get money back if you're eligible for the American Opportunity Tax Credit. So that is like they are paying you money. You're not just getting, your taxes back. That's why it's so good. So it's 100% of the first $2,000 and then 25% of the next $2,000. So that's how they get to the $2,500. Like I said, it's only available for undergrad, and you can only claim it for 4 years. You have to be enrolled at least half-time, at least for one semester. And then the qualifying expenses are great because it's tuition, fees, books, supplies, equipment. If you get a scholarship, you have to reduce. You can't double dip. So you have to reduce any expenses by any scholarship or grant that you get. You can't have any felony drug convictions, and there are phases, which means, let's say on here, if you look at this, it says phase out 80, 90,000. So if you make 80,000, that benefit starts to phase out and is entirely phased out at 90,000. And then it's 60 for single. That's for single. Married filing joint, it's 160 to 180. So it's very good when your parents are claiming you, but if your parents are not claiming you and you're between the ages of 18 to 24, you can take this, but you are not eligible for the refundable portion of the credit if your parents provided more than half of your support. So you kind of have to be on your own to be able to get the full benefit of this credit. And the items in yellow just represent the difference between this credit and then the credit that graduate students are eligible for, which is this next one. It's the lifetime learning credit. So still a credit and still great. It's just not as amazing. So this is up to $2,000 per return. So where we talked about the American Opportunity Credit is per student, this is per return. So if you have 4 kids, then only one of them can get this. So 20% of the first 10,000 of qualified education. So to max this out, you'd have to spend $10,000. It's a little bit harder to get to. It's available for any type of education. So if you want to improve your job skills, if you're getting your graduate degree, and you don't have to be pursuing a degree. So just so you know, any type of classes that you take, you may be eligible for this someday down the line also. You do not have to be enrolled half-time. But qualifying expenses. So you get tuition and required fees, and then course books, supplies, and equipment paid to the institution as a condition of enrollment. So that one's a little bit harder because the university has to require it for you to be enrolled. So if you can go get your books, somewhere else, those may not qualify. Again, reduce expenses by scholarships and grants. It phases out a little bit lower, 59 to 69 for single and 118 to 138 for married filing joint. So those are the two education credits that are available that I encourage you to take. See if you're eligible. Definitely check those out. Then maybe you're not eligible for credit. So there is the tuition and fees deduction, which taxpayers can deduct. So the one thing about this is you have to provide more than half of your support to take this. If you don't, your parents basically, if they don't claim you as a dependent, then no one gets the credit. So I would definitely say if you don't provide more than half of your support, your parents should claim you, and this is a deduction that they can get. Again, it's a deduction though, so it just reduces your taxable income. So it's not as favorable as the credits. And you can have a deduction of $4,000 basically for single. Sorry, if your modified AGI is $65,000, and then you can take $2,000 if your income is a little bit more. And the qualifying expenses are the same, similar: tuition and required fees, supplies and equipment, but they have to be paid to the institution as a condition of enrollment, and again, reduce them by scholarships. And like I said, if they are dependent and your parents decide not to claim you, no one gets the deduction. So that's kind of, they try to limit that. Okay, so then we have qualified tuition programs. So this, they're called 529 plans, is what you've probably heard of them referred to. And we have education savings accounts. So contributions to these accounts, they're not deductible. So the year you make a contribution, or maybe you have a child and you make a contribution to their 529, it's not deductible. But what happens is it sets in this account and the earnings accumulate tax-free. So, you can start it when they're young, let it build. And then when you take that money out, it's tax-free if it's for their qualified education expenses. And I think last year or the year before, they actually changed the law where you could use this for K through 12 expenses up to $10,000. So if you had a 529 plan, you could pay private school. You could use it to help pay private school, which is something new. Now you can claim this and education credits, but not for the same expenses. So you can't double dip on any of these. You've got to kind of look at what's best for your situation. And I will tell you that TurboTax does pretty good at that. Now we have scholarships, fellowships, and grants. So this chart just kind of laid it out the best way. So if most of the time scholarships and fellowship payments, basically, they are tax-free. So if you're using them for tuition, if you're using them for books, supplies, equipment, if they don't prohibit that in the grant, then those are tax-free. If you use the money for room and board, travel, those could be taxable. So just be aware, and honestly, there are things you can do to maximize the tax benefit by looking at the scholarship. Sometimes it's better for people to include a scholarship in income and then take the credit. But it is really just, a trial and error. You're going to have to look at that. And then some things that are available that can help pay for school. Basically, if you have an IRA, which is just money that you have put in a retirement account, and you are not supposed to touch that money until you're age 59 and a half. Now, we all know things happen and you might need that money before you're 59 and a half. If you try to dip into your IRA or retirement before you reach that age, you have to pay tax on that money, and you have to pay a 10% penalty on taking that money out before that age. Now, if you use an IRA distribution to pay for education expenses, then you can avoid that 10% penalty. And something good is it's the taxpayer, spouse, child, grandchild. So if there's an IRA available, you do avoid the 10% penalty. You still have to pay tax, but And like I said, there's caveats to everything. Well, because of COVID, there's now some special rules about this 10% penalty. So if you did happen to take an IRA distribution because of COVID, then there are special rules about you can, pay that back. You can pay the tax over 3 years. You can avoid the 10% penalty. So just know this year there are definitely some special rules if you, happen to take a distribution because of COVID. And then student loan interest. If you happen to be paying back a loan, a tuition, basically an education loan, they're going to report student loan interest to you on a 1098-E. That deduction belongs to the person who is legally obligated to pay the loan. So if your parents pay it, but it's your legal obligation, then you get the deduction. So the maximum is $2,500 of interest, and then it does phase out. So once you make $85,000 as a single person, it totally phases out, and you don't get any type of deduction. Married filing joint is $170,000. So now I thought we would just maybe kind of walk through an example of a tax return. I just made some assumptions, and I thought we could look at that. And I don't know, Navina, are there any questions? Do we want to take any questions?
Sure, there are a couple of questions. So the first one is, what about married who file separate during divorce process? Is there any income limit?
There is. So I guess the question would be for what exactly? Because some things are not available when you are married filing separate. And one thing I usually tell my clients, if it is a amicable relationship, then I would do everything you could to try to file jointly because it's usually better. But if that is not possible, then it just depends on if you're looking at a credit or if you're looking at a deduction. But you need to look at the rules for married filing separately because they are different for everything.
Thank you. Let's see. Next is, how do we claim them during filing? Shaiman, can you go a little deeper on that one? She meant for lifetime education.
For what? The married filing separately? Oh, how do you claim them on the return? Oh, we will look at that in just a second.
Okay. Okay. And then last question is, the last 2 years I've claimed my scholarships as income in order to take the lifetime education credit on all of my expenses. This year, it's not worth it for me to do so. Will the IRS flag that inconsistency, claiming scholarships as income in the first 2 years, but not the third?
Usually not. The way I see it sometimes is the IRS has, and that is something that you did, and you worked the system in an honest way to get the best results for you. But no, I would definitely not see that as a flag at all. And I would just do what works for you, what works best for you.
Thank you. Those are all the questions so far.
Okay. So hopefully we can look at that, claiming that lifetime learning credit on here, because our grad rebel is eligible for that. So just some background on our example. So he does graphic design. That's kind of his background. And he was working hours as needed at XYZ Graphic Design as an independent contractor. So basically he earned $2,500 for the year, and they reported that to him on a 1099 NEC. Now, if you work as a 1099 employee, that means you are responsible for your self-employment taxes, which is Social Security and Medicare, which is about 15%. Now, the good thing is you get to deduct your expenses, if you have any, before the tax is calculated. So let's say, in my example, he doesn't have any, but let's say he earned $2,500, but he has $1,500 in expenses. He would only have to pay the self-employment tax on the $1,000. So that is a bonus, is you get to write off expenses. But you have to pay that 15%, which sometimes is a little painful if people make a lot of money on their 1099. So that's his first thing. Second, he quit his job at XYZ Graphic Design because he got hired as an employee at ABC Printing. So he earned $20,000 on a W-2 for 2020. Now, that's beneficial because now that he's a W-2 employee, his employer is going to pay half of that self-employment tax. So when you're an employee earning a W-2 wage, your employer pays 7.65%. and you pay 7.65. Now, you don't see it's seamless. They withhold it from your paycheck, and you'll see it on a pay stub, and they submit it to the government on your behalf. But at least your employer's paying half of it for you. So that is his W-2. He attends graduate school at UNLV, and he paid tuition of $3,000 in 2020, and he got this reported to him on a 1098-T. Also, he is paying off his graduate student loans once he got a job. So he paid $225 in loan interest reported to him on a 1098-E for 2020. Now, we're assuming he is 26 years old. His parents don't claim him as a dependent, and he provided more than half of his own support for 2020. So he's going to file single. So just to show you kind of what these forms look like, this is a 1099 NEC, and you can see here, there's his $2,500 issued to him. There's his social security number because XYZ Graphic Design sent this to the IRS and told them to be looking for $2,500 on his return. And if he didn't report it, they would send him a nice little love note to say, well, you forgot this? It's all taxable. You owe us X dollars. So the IRS just assumes that it's all taxable. So I will tell you, if you get an IRS letter and you think at all that it could be wrong, do not pay it. Get someone to look at it for you. Get a CPA to look at it for you, because I will tell you 8 times out of 10, it is wrong. Not that intentionally they're doing it wrong. It's just that they're going to assume worst case scenario. If you didn't report the sale of a stock, they'll assume you paid $0 for it. So just be very confident before you pay an IRS bill, because if you pay it, you will never, well, you might someday get the money back, but it will be years, probably years, and it will be hours off of your life that you will work to get that back. W-2. So here is his W-2 from ABC Printing, and you can see in box 1, $20,000. And they, because of his exemptions, or because of what he put on his W-4, they withheld $1,500 in tax for him, and they submitted that to the IRS on his behalf. So when he files his return, the IRS would expect to see $20,000 and $1,500 withheld, and they match that up to make sure you're reporting what they think you should be reporting. And like we talked about, here's his Social Security wages. They're the same for this in this example, and that is his basically employer and employee portion. So that's 12.4%. And then here we have the Medicare, which is 2.9%, so $290. So added together, that's what I was referring to, is the 15%. So that's that. And then we have his 1098-T. You probably have all seen these. So here it says, okay, here are the payments that he paid for tuition. If you have a scholarship or grant, it's going to be in this box. Box, I think that's 5. I can't see very well, but maybe 6. Sorry. And then down here, it says check if at least a half-time student. Yes, doesn't matter, because over here, he's a graduate student. So in order to take the lifetime learning credit, you do not have to be a half-time student, but he was for 1 semester, so it's marked. So then if we look, and I hope you guys can see this, I am definitely not a PowerPoint expert. I had someone help me, but this is pretty small. But here, okay, so we have the page 1 of his Form 1040. So up here you can see there's where he marked he's single, filing is single, name, address, whatever, all that stuff. Then a new question on the 2020, it's not a new question. It's a question that got moved to the front page of Form 1040, is at any time during 2020, did you basically do anything with virtual currency? So we have to ask all of our clients, did you do anything with virtual currency? Because the IRS is figuring out that people aren't reporting any gains that they have on virtual currency. So they are now tracking that down. So you have to answer that question. Then right here, you can mark if someone can claim you as a dependent, you can mark that here. Oh, no one can claim him as a dependent, so it doesn't mark that. If you have dependents, you would list them right here. So then we have wages. So this 20,000 is his W-2, 20,000 that we saw from ABC Printing. Then we come down here and we have other income. So that's coming from another schedule, but once we put that on Schedule C, that $2,500 shows up here as his self-employment income or his 1099 NEC. So that gives us his total income. And then right here, we have his student loan interest deduction. Now, it gets a little confusing. What's also added in there is he gets a small deduction for his self-employment taxes that he paid. So that's $177. And then his $225, he gets the full student loan interest. So that is in that number. So we come down here and he gets a standard deduction. Now, you can either take a standard deduction or you can itemize. They increased a few years ago when the Trump tax reform came through, they increased the standard deduction. So it is now $12,400. So most of the time, the only way you're going to itemize is if you have a mortgage and you pay mortgage interest, because itemized deductions include things like charitable donations, any type of taxes paid. So real estate taxes, DMV taxes, sales taxes, and then it's your mortgage interest. So it's really hard to get above $12,400 unless you have that mortgage or unless you're donating a lot of money. And then your medical is also included in there. But in order for medical to even make a dent, it has to be more than 7.5% of your income. So that's usually only in extreme circumstances does that happen because of insurance and things like that. But, sometimes people can get there without having a mortgage. But just so you know, the standard deductions, it's really the best in most cases these days. So you come down and you have his taxable income, and that's 9,000 something. 9,000, I can't see that very well, so I hope you guys can. So we come over here and we have his total tax calculated. So I'm going to have to pull up my other sheet so I can at least maybe follow along. So, or put my glasses on. You guys are going to have to see my glasses. Okay, so his tax is $968. Well, then whoever asked about lifetime learning credit. So we have here, this is where it shows up. Now there's a schedule that has to be done that flows through to this front page. So we knew that he had $3,000 in tuition, and he gets 20% up to $10,000. So that is $600. So his tax was $968. He gets a credit of $600, which is why the credit is so good. That brings his tax down to $368, which is very favorable. So then in here, this other taxes line represents what I told you, the self-employment taxes that he's having to pay on that $2,500. So we're having to add back $353 in self-employment taxes. So his tax is $700, $721, but he had tax withheld of $1,500. So what is happening, and we'll talk about some of this other stuff in a second, but he is getting a refund of $779. So, he did a good job. He had a good amount withheld. Now, the other thing is the stimulus check. So if you received the stimulus in 2020, so the first stimulus was $1,200 per person, and then $500 per child. If you got that stimulus, you don't put anything on your return. The second stimulus was $600 per person. So let's say that he had not received that stimulus. He would get it when he files his 2020 return, because the stimulus was just a kind of advance on your 2020 taxes. So let's say that he made too much money in 2019 and he did not qualify for the stimulus. When he files his 2020, if his income dropped and he qualifies, he gets the money then. So let's say his parents claimed him as a dependent last year, 2019, and now he's not a dependent and he does really provide more than half of his own support. He would also get the stimulus, and his parents do not have to pay it back. So that is going to go, it's right here on line 30, recovery rebate credit. So just anyone who didn't get that stimulus and you think you're eligible, you'll definitely want to put that through on your 2020 tax return. So just a heads up. And if you had the American, see down here, there is line 29, American Opportunity Credit. That's the refundable portion that would go in here. I didn't do that credit because it's only for undergrads. So that's pretty much our example. I didn't want to get too far into it. So I don't know if you guys have any other questions. 40 minutes of taxes is probably anyone's max.
This is great information. Thank you. So it looks like we have another question. What if a student has been working as a part-time student and has a W-2 for 2020?
So what I recommend is, first of all, see if you have to file. So see if you're below the threshold. If you're under 12,400, then you may not need to file. But then look at box 2. And if box 2 has tax withheld, I would at least go through the process on the IRS free file and see if you might get a refund. Because never let the IRS keep your money, especially if you can file for free.
Thank you. So someone said, what about investments in stocks or retirement like TSP?
So I'll answer a couple of questions. I'm not sure your specific question, but let's just say you have an investment and you have some stock, but you don't do anything with it. You put your money into it and you just let it sit there. You don't have anything to report unless you got dividends. Now, if you got dividends, you're going to get a 1099 DIV. But let's say you didn't earn dividends on your stock, that the money just sat there. There's nothing to report because you might have put $5,000 into this investment. It could be worth $12,000 right now, but it's not realized. There's nothing to pay tax on because you don't have access to it. But let's say you have the stocks and you bought it for $5,000 and you sold it for $7,000. So now you do have a realized gain. So that's a $2,000 gain. So if you held that stock over 1 year, your tax rate's 15%. And if you're in a low tax bracket, that tax rate might be 0. So you might pay 0 on that. But if you did not hold the stock for longer than a year, then you're going to pay your ordinary income tax rates, depending on what tax bracket you're in. But it is most likely taxable unless you're in a low tax bracket.
So our next question was, which line was for stimulus eligibility?
Oh, let's just go back up. I think it was on, let's see. Okay, so this one right here, line 30, recovery rebate credit. So most likely, whatever software you're using, my software asked me, did you get the first stimulus? How much did you get? And so let's say you put in $1,200. So it's going to say, oop, you don't get anything additional. And then for the second one, let's say you didn't get it yet. Then you'd put 0 and $600 would show up here that you were entitled to. So yeah, so line 30. But there's some background calculations going on that you probably have to get through before you get to that number.
And what about savings and international accounts?
International. Okay. So on your savings accounts, You will be, well, okay, so if they're U.S. accounts, they're going to report to you the interest. So you're going to get that reported to you on a 1099 interest form. Now, if you have foreign accounts, if at any time during the year all of your balances or more than $10,000, you have an additional reporting requirement. It's called an FBAR. So foreign, I don't even know what it stands for. It is not fun, but you have to basically file on this IRS system that says, here's my account number, here is how much, here's my highest balance during the year, here's the address of the bank. You have to report all of that to the IRS because they're not going to let anything get past them. If you did not have over $10,000 in the account during the year, then you do not have to do the FBAR. But as you know, as someone, as a U.S. citizen, if you're filing a tax return, you have to pay tax on worldwide income earned. So if you have a foreign account and you earned interest on it, you are supposed to report that on your tax return.
So someone said that they think they received a second stimulus in 2021. Do they still need to report as they are filing for 2020?
Okay, so are you meaning that you received it in 2021? Let me answer. Okay, so I think you are. So here's what happened. The first stimulus, we know it was in 2020. Most people got their money in 2020. So then on December 27th, they decided to do the new stimulus. And I don't think anybody got their money until 2021, but it's still coming through on the 2020 tax return. So, and I'll tell you, I know people who just got the stimulus last week, but the IRS is going to check and see if you really got that stimulus, if you said no. So there's going to be a check. But yes, it still goes on your 2020 tax return. That is why the IRS is not accepting tax returns until this Friday, because they're still updating their system.
Thank you.
Yeah, if that didn't answer that question, just have them talk back or turn off their mic.
So how do unemployment benefits due to COVID affect our tax return?
Well, unemployment is taxable. So just so you know, it comes through your tax return. Let me just page up here and I'm going to show you. Oh boy, if it's going to be actually on this line right here. It's other income. So there's another schedule, Schedule 1, and your unemployment benefits are taxable. So now I'll tell you, I know Biden is talking about passing some new tax laws. And one thing that's been thrown around is saying that the first $10,400 would not be taxable. I don't know how they could pass that now because people have already filed, or at least, attempted to file. The IRS isn't accepting them, but our software takes it. But as of now, unemployment is taxable, whether it was the PUA or just your regular unemployment. But I always advise people, if you think you're going to owe tax, have tax withheld from that unemployment if you can.
So someone followed up with that, asking, what if they got their unemployment for 2020 in 2021?
Well, the Dieter should put that on your 2021 1099-G. I can't say for sure if that's going to happen because there's been a lot of reporting errors, but you just need to go off of your 1099-G form that you're going to get from the Department of Employment and Security Division. That is the form that you need to use. And I think they had to mail those by February 1st. So whatever that form says was your unemployment is the number that you should report on your return. I mean, unless you're like, this is totally wrong, then you need to have a conversation with them. I had a client, I think 2 days ago, she has a fraudulent claim out there for at least 6 months that someone incorrectly filed it with her social security number, and she got the 1099-G. So they haven't sorted it out. But that is what Dieter is going to be sending to the IRS. So unless there's a big problem, that's what you need to report.
Thank you. So if anyone else has any questions, please take a minute to think about those, or feel free to unmute yourself and ask the question as well.
Yeah, I have a question. So suppose, let's say if we file previously I filed jointly in 2019, and we got the stimulus check, the jointly, and now in 2020 I'm filing separately, the individual. So do I need to mention that what we got in a stimulus check jointly, or I need to mention my part?
Okay, so did you get the full stimulus?
Yes, me and my wife, I got this. I got the full stimulus.
Yes.
Not sure, like somewhere around maybe above 2,500 or 2,900. I don't know.
Okay. Yes. So what's going to happen is you should report your portion. But what you want to check is after you put your numbers in, you just want to make sure that that line 30 is 0, because you already got the full stimulus, so you shouldn't be getting anything additional. But you would probably put in your portion, and your wife puts in her portion, and it should not calculate any additional stimulus.
Okay. Okay, thank you.
I have a question about gift tax over $15,000. Who will be responsible for gift tax, basically?
Okay, say that. Oh, you got a gift over $15,000?
Yes.
Okay, so that is gift tax. So that is the person giving the gift. So if you received the gift, you don't have to report that. The person giving you the gift is the one obligated to report that.
Okay, what if it's belonged to 2 years ago?
If 2 years ago, you know what? They should have reported it 2 years ago, but I'm going to tell you something on that. So gift taxes, you can give up to $15,000 without reporting anything. Once you get over $15,000, and let's say my husband and I gave a gift to my daughter, and we can each give her $15,000. So that's $30,000 before we have to report it. And even once you have to report it, you get like millions of dollars. I think it's, I don't know, 2 million. It might be even more, but you can give up to that much in gifts before you have any gift tax. So it's not like a huge risk unless they're giving a lot of gifts, but also it's on the person giving the gift, not on you.
Yeah, but I mean, for the person, if IRS find out that he has paid that much gift, still he will be responsible to pay the gift tax, right?
Yes, but you get a lifetime amount you can give. So unless he's given over a couple $1 million, there will be no tax.
Oh, then what is the over 15,000 gift tax rule?
If it's over 15,000, you just have to fill out a form, a gift tax return.
Oh, okay. Thank you.
Yeah. So no tax. So, I mean, I guess if they found out, they would ask for that form, and maybe there'd be a penalty, but the likelihood is low.
Thank you so much.
You're welcome.
So are there any super common mistakes people make when filing as an independent contractor, sole proprietor, or single owner LLC?
Mistakes. I guess, I really don't think a lot of people miss out on deductions. They try to, I don't know, I guess it just depends on the person. So either some people go too far and they try to write off 100% of my car is for business. Everything I did for my one car I own was for business. That's just not likely. But then I've seen the other extreme where people don't take advantage of deductions they are entitled to. A lot of people I talk to, they're like, oh, I don't want to take that home office. That will put a flag on me. And my question is always, did you have a home office? Did you use a home office? I have no problem signing a return where you actually used something. So I definitely tell people the one good thing about being a sole proprietor is you are entitled to deductions. So I say take them, but they have to be in the ordinary course of business. So it has to be ordinary and necessary. So, but you have a little gray area when you have your own business. So just keep that in mind.
Thank you.
Uh-huh.
Just give everyone a few more seconds to think of any other questions. Please feel free to unmute yourself.
Can I ask last question about single owner LLC?
Uh-huh.
I'm curious. It's not any case. I just want to know if someone as a single owner of LLC, they just claim very like individual personal expenses deduction, what will happen? I mean, against the law. I know that it's not legal, but what will happen?
Well, so, and you mean basically not business expenses. They're claiming something maybe they shouldn't have.
Yes.
Okay. So I actually, this is another case I had that went to the IRS. So sometimes you will have tax preparers who like to deliver good news, which, we'd all love to do that, but that's just not always the case. So he put some deductions on a return, $10,000. I can't even remember what it was for, some other deduction. It wasn't even specific, and it was an even $10,000. And my client, I inherited him. He's like, I didn't spend $10,000 on anything. Well, that's why he was getting audited. So what happens is if you get caught or audited, then what they can do is they can not only assess the tax, but they can assess an accuracy related penalty to the tax. And that's usually if your tax is more than 20 or less than 20% of what it should be. Basically, there's a 20% error. So in addition to just paying the tax, you have the penalties and the interest that are steep. I mean, they're just, they can just assess penalties all around, 20% here. And, it's just, it's not good. But that is if you get caught. I don't want to say you should do that. Don't do that. But that is if, the IRS finds it. And sometimes what they do, maybe it's not an audit, but, if I've had clients who had maybe a big charitable donation, they will just send a letter and say, we need proof. So it requires no time from them, from the IRS. They send a letter and the onus is on us to prove that we really did that. So that is something that could happen.
Thank you.
Uh-huh.
All right then, before we wrap up, I just wanted to give a huge thank you to Allison. Thank you so much for sharing your time with us today. This is such a relevant and timely topic for a lot of us right now, so we really appreciate your time.
Of course. Thank you guys for having me.